Well, thank you for being here today. I'm 95 years old, and I've lived through more economic crises than most people have lived birthdays. I've seen stagflation, oil shocks, market crashes, bank failures, tech bubbles, housing bubbles, financial meltdowns, and pandemics. And through every single one of them, people have asked me the same question. Warren, should I be worried? Should I sell everything and protect myself? And you know what my answer's been every single time? It depends on what you mean by protect yourself. Today I want to talk about something that's on everyone's mind. The U.S. economy feels shaky. Inflation has been stubborn. Interest rates are higher than they've been in years. Government debt is at levels that make people nervous. The stock market has been volatile. Political division is intense. There's this AI revolution creating both excitement and disruption. And every day, the financial media is telling you about some new crisis or catastrophe that's supposedly right around the corner. So the question I want to address is this. When things feel uncertain, when the economy feels shaky, should you play defense and protect what you have, or should you go on offense and seize opportunities? Should you be conservative or aggressive? Should you hide or should you hunt? And I'm going to give you an answer that might surprise you. But first, let me take you through some history, because if you understand how these situations have played out in the past, you'll be much better equipped to handle whatever comes next. I've been investing since 1942. That's 83 years. And in that time, the economy has always felt shaky to somebody. There's always been something to worry about. There's always been uncertainty. There's always been a reason to be scared. In the 1,970 seconds, we had stagflation, a combination of high inflation and economic stagnation that economists said was impossible. Oil prices quadrupled. Interest rates hit double digits. The stock market went nowhere for a decade. People were convinced American prosperity was over, that we'd been surpassed by Japan and Germany, that the future was bleak. I was finding wonderful companies at attractive prices because everyone else was too scared to invest. Those investments made during the 1,970 seconds became some of the most profitable of my career. In 1987, we had Black Monday. The stock market dropped 22% in a single day. Trading systems failed. People thought the financial system was collapsing. The panic was extraordinary. Everyone wanted to know if this was the end. I wrote an article for Forbes titled Buy American I Am. I explained why I was optimistic, why I was investing in American businesses, why the panic was creating opportunities rather than disasters. Within 2 years, the market had fully recovered and gone on to new highs. In 2000, we had the dot-com bubble burst. Trillions of dollars in market value vanished. Companies that had been worth billions went to zero. The NASDAQ lost 78% of its value over 2 years. People who had been millionaires on paper were broke. The economy felt very shaky. Charlie Munger and I had stayed away from the speculation, so we didn't lose money when the bubble burst. And after the crash cleared out the excess, we were able to find reasonable valuations again. Then came 2008, the worst financial crisis since the Great Depression. Major banks collapsed. The credit markets froze. The government had to bail out the financial system. The stock market dropped 55%. People were genuinely scared that the entire system might collapse. And what did we do at Berkshire? We deployed billions of dollars. We invested in Goldman Sachs, General Electric, Bank of America, all at very favorable terms. Why? Because we had cash when everyone else was desperate. Because we understood that American business would survive and thrive. Because we knew the panic was creating once-in-a-generation opportunities. More recently, in 2020, COVID hit and the market crashed 34% in 3 weeks. Once again, everyone was convinced the economy was finished, that we'd be in depression for years. Within 5 months, the market had recovered completely. Do you see the pattern? The economy always feels shaky to someone. There's always uncertainty. There's always something to worry about. But American business keeps adapting, keeps innovating, keeps creating value. And the investors who stay calm, who think long-term, who see opportunity in chaos, they're the ones who build lasting wealth. I've never made an investment based on macroeconomic predictions. I don't try to forecast interest rates or GDP growth or unemployment numbers. I can't predict those things, and neither can anyone else, despite what they claim. What I do is identify wonderful businesses with durable competitive advantages, and I buy them when they're available at reasonable prices. Everything else is just noise. Here's something I learned a long time ago. Uncertainty is the friend of the long-term investor. When everyone is certain, when everyone is confident, when everyone is optimistic, that's when prices are high and opportunities are scarce. But when everyone is uncertain, when fear is elevated, when people don't know what's going to happen, that's when prices become attractive. So when you ask me if the economy feels shaky, my response is, it always feels shaky to someone. The question is whether you're going to let that fear paralyze you or whether you're going to use it as an opportunity. Now let me explain what's making people nervous about the economy today, because I think it's important to separate real concerns from manufactured panic. First, interest rates are higher than they've been in years. After more than a decade of essentially zero interest rates, we're now in a world where money has a cost again. This affects everything. Borrowing is more expensive, bond yields are higher, stock valuations need to adjust. This is real, this matters. But here's what people forget. For most of economic history, these interest rates would have been considered normal. We got used to an abnormal period of zero rates, and now normalization feels scary. But businesses can adapt. Good businesses can still thrive in this environment. Second, inflation has been stubborn. After years of low inflation, prices for food, energy, housing, and other essentials have risen significantly. This hurts consumers and creates uncertainty about the future. But again, context matters. Good businesses with pricing power can pass along cost increases to customers. Coca-Cola, Apple, companies with strong brands, they can raise prices when costs go up. Mediocre businesses without pricing power, they struggle. This is actually an environment that separates quality from mediocrity. Third, government debt is at levels that make people uncomfortable. The U.S. has over $30 trillion in debt, and it keeps growing. People worry about sustainability, about inflation, about future tax increases. This is a legitimate concern. But it's also not new. People have been worried about government debt my entire life, and yet American business has thrived. The key is owning productive assets that can maintain their real value even if the currency depreciates. Fourth, certain sectors of the market feel overvalued. The AI boom has driven some stock prices to levels that don't make sense based on current fundamentals. There's speculation disguised as investing. This creates fragility. This is also real. But here's the thing. You don't have to participate in the speculation. You can own reasonably priced businesses with actual earnings and let the speculators do their thing. Fifth, political division and dysfunction create uncertainty. Policy is unpredictable. Regulations change. There's constant drama. This makes people nervous about the future. But American business has thrived under every administration, every Congress, every political environment for over 2 centuries. Good businesses adapt to whatever political reality exists. The overall point is this. Yes, there are reasons for concern. There are always reasons for concern. But economic cycles are natural, predictable, and survivable. Recessions happen. Markets crash. Things feel scary. And then they recover. This has been the pattern for as long as markets have existed. So, should you play defense? Let me explain what defensive investing actually means. Defense means capital preservation. It means your primary goal is to avoid permanent loss of capital. That means you structure your investments so that even in terrible scenarios, you're uncomfortable but not destroyed. For me, defense has always included several key elements. First, no leverage. Never borrow money to invest. Leverage is how fortunes are destroyed during downturns. When you use leverage, you create the possibility of forced selling at exactly the wrong time. This turns temporary market declines into permanent losses. Don't do it. Second, maintain adequate cash reserves. Cash feels like it's losing to inflation, especially in uncertain times. But cash is optionality. Cash is the ability to act when opportunities arise. Cash means you never have to sell something you don't want to sell. At Berkshire, we always keep substantial cash and treasury bills. Right now, we have over $150 billion. People criticize this, saying we're not putting our money to work. But that cash has allowed us to make extraordinary investments during every crisis. It's defensive in that it protects us from forced selling, and it's offensive in that it lets us act when others can't. For individual investors, I'd suggest keeping at least 6 to 12 months of living expenses in cash if you're working, and 1 to 2 years if you're retired. This buffer means you can ride out any storm. Third, own businesses with durable competitive advantages, what Charlie and I call moats. Companies with strong brands, network effects, cost advantages, switching costs, anything that protects them from competition. These businesses can weather economic shakiness much better than mediocre companies. Coca-Cola survived the Great Depression, multiple recessions, wars, and every crisis in between. Quality businesses with moats are inherently defensive. Fourth, avoid speculation. No cryptocurrency, no meme stocks, no options trading, no day trading, no chasing hot sectors. Speculation might work in good times, but it destroys wealth during uncertain times. Stick to real businesses with real earnings. Fifth, focus on businesses you understand. If you can't explain how a company makes money in simple terms, don't own it. Complexity is the enemy of sound decision-making, especially during uncertain times. For people over 50, defense becomes even more important. You have less time to recover from big mistakes. Every dollar you lose is a dollar that can't compound during your remaining investing years. So you need larger cash reserves, you need to focus exclusively on quality, and you need to avoid speculation entirely. But here's what defense doesn't mean. It doesn't mean selling everything and hiding in cash. It doesn't mean market timing. It doesn't mean abandoning productive assets. Because while you're defending against short-term volatility, you also need to think about long-term threats like inflation and missed opportunity. So should you go on offense? Let me explain what offensive investing means. Offense means recognizing that uncertain times create opportunities. It means having the courage to deploy capital when everyone else is scared. It means seeing temporary dislocations as gifts rather than disasters. For me, offense has always been about a few key principles. First, great companies get temporarily mispriced during crises. When fear is elevated, when uncertainty is high, when everyone is worried, even wonderful businesses with strong fundamentals see their stock prices decline. This creates opportunities to buy quality at attractive prices. During the 2008 financial crisis, businesses like Goldman Sachs, General Electric, and Bank of America were available at prices that made no sense if you believed American business would survive. We deployed billions of dollars because we understood these were temporary dislocations, not permanent impairments. Second, panic creates the best opportunities. Be fearful when others are greedy, and greedy when others are fearful. This isn't just a catchy phrase, it's the entire playbook for offensive investing. When everyone is confident and optimistic, prices are high and opportunities are scarce. That's when you should be building cash and being selective. But when everyone is terrified and pessimistic, when the economy feels shakiest, that's when the best investments are available. Third, cash reserves become ammunition. The defensive posture of maintaining cash transforms into an offensive weapon during crises. You can deploy that cash into wonderful businesses at bargain prices while everyone else is selling. This is why I say the best investors are both defensive and offensive. You defend by maintaining liquidity and avoiding stupid mistakes. You go on offense by deploying that liquidity when opportunities arise. Fourth, you need to ignore macroeconomic predictions. I can't tell you whether we'll have a recession next year, whether inflation will spike or fall, whether interest rates will go up or down. Nobody can predict these things consistently. What I can do is identify businesses with strong competitive positions, capable management, and reasonable valuations. If I buy enough of these businesses over time, the macroeconomic fluctuations don't matter much. Good businesses adapt and thrive regardless. So here's the balanced answer to the original question. Should you play defense or go on offense? The answer is both simultaneously. Let me explain how this works in practice. At Berkshire Hathaway, we maintain a strong balance sheet. We have no debt at the parent company level. We have substantial cash reserves. We own businesses with predictable earnings and strong competitive positions. This is defense. But we're also always looking for opportunities. When markets dislocate, when fear creates bargains, we deploy capital aggressively. We bought BNSF Railroad. We bought significant stakes in Apple, Coca-Cola, American Express. We made opportunistic deals during crises. This is offense. The key is that our defensive posture enables our offensive moves. Because we're not desperate, because we're not forced sellers, because we have liquidity, we can act decisively when opportunities arise.
For individual investors, this means structuring your portfolio so you're protected against disasters, but positioned to benefit from opportunities.
Keep adequate cash reserves. This is defensive. But also identify wonderful businesses you'd love to own at the right price, so when fear drives prices down, you know what to buy. This is offense. Own quality businesses with durable moats. This is defensive because these businesses can weather storms. But it's also offensive because quality compounds value over time better than anything else. Stay calm during volatility. Don't panic sell. This is defensive. But also be willing to buy more during crashes. This is offense. The worst thing you can do is try to time the market, selling everything when things feel shaky, then trying to get back in when things feel better. This almost never works. By the time things feel better, prices have already recovered. Let me share one of my favorite quotes. Risk comes from not knowing what you're doing. The economy feeling shaky isn't risk if you own wonderful businesses at reasonable prices and you have adequate liquidity. That's just volatility, temporary noise. Real risk is owning things you don't understand. Real risk is using leverage. Real risk is speculating instead of investing. Real risk is panicking and selling at the bottom. These are the things that create permanent loss of capital. Never bet against America. This is something I've said many times, and I mean it. American business has overcome every challenge it's faced for over 2 centuries. Wars, depressions, political dysfunction, foreign competition, technological disruption, you name it. And American businesses thrived through all of it. Yes, the economy feels shaky sometimes. Yes, there are legitimate concerns. But betting against American ingenuity, American capitalism, American innovation, that's been a losing bet throughout history. The stock market is designed to transfer money from the impatient to the patient. During uncertain times, the impatient panic and sell. The patient stay calm and buy. Over decades, this difference compounds into enormous wealth. Now, let me give you some very specific practical guidance for investing during uncertain economic times. For regular investors who don't have the time or inclination to pick individual stocks, my recommendation remains the same. Low-cost S&P 500 index funds. When you buy an S&P 500 index fund, you own 500 of America's largest and best companies. You're automatically diversified. The fees are minimal. And over long periods, you'll likely beat 90% of professional investors. Don't try to time when to buy these index funds. Just set up automatic monthly purchases and stick to it, regardless of what the economy is doing. This dollar cost averaging means you buy more shares when prices are low and fewer when prices are high. For older investors, people over 60, you need a more conservative approach. I'd suggest 50 to 60% in stocks, mostly index funds or high-quality dividend-paying companies. 30 to 35% in short to intermediate-term bonds, and 10 to 15% in cash. This allocation provides growth from stocks, stability from bonds, and flexibility from cash. Adjust these percentages based on your specific situation, but the principle is to balance growth with protection. Avoid margin and leverage completely. I can't emphasize this enough. Borrowing money to invest during uncertain times is financial suicide. Even if you're right about the long term, the short-term volatility can wipe you out through forced selling. Avoid cryptocurrency, meme stocks, options trading, and other forms of speculation. These are gambling, not investing. During uncertain times, you want to own real businesses with real earnings, not speculative assets with no intrinsic value. Focus on businesses with strong fundamentals. Look for companies with durable competitive advantages, consistent profitability, strong free cash flow, reasonable debt levels, and capable management. These businesses can weather economic shakiness. Reinvest dividends. Don't take the cash. Let it automatically purchase more shares. This accelerates your compounding and removes emotion from the equation. Never ever panic sell. This is the single biggest wealth destroyer during uncertain times. When you sell during a downturn, you lock in your losses. You guarantee that you'll never recover. The people who build lasting wealth are the ones who hold through volatility or even buy more. Let me give you my 3-step strategy for navigating a shaky economy. I call this protect, prepare, and pounce. Step 1, protect. This is about eliminating vulnerabilities. Pay off all high interest debt. Credit card debt at 18%, car loans, anything with high interest rates. You can't build wealth while paying those rates. Eliminating this debt is a guaranteed high return. Build an emergency cash fund of 6 to 12 months of expenses. This protects you from having to sell investments at the wrong time. This is your first line of defense. Own stable, proven businesses or low-cost index funds. Not speculative startups or trendy sectors, quality businesses that have survived multiple economic cycles. Avoid catastrophic mistakes. No leverage, no speculation, no panic selling, no complexity you don't understand. Most wealth destruction comes from stupid mistakes, not from missing opportunities. Step 2, prepare. This is about positioning yourself for opportunities. Build additional cash reserves beyond your emergency fund, maybe 10 to 20% of your investment portfolio in cash or treasury bills. This becomes your opportunity fund. Study businesses. Identify wonderful companies you'd love to own at the right price. Make a watch list. Understand what they're worth. Know what price you'd be willing to pay. Understand valuations. Learn to think about businesses in terms of their earnings, cash flows, and competitive positions, not in terms of whether the stock price is going up or down. Strengthen your temperament. This is the most important preparation. Practice staying calm during volatility. Remind yourself that you own businesses, not ticker symbols. Train yourself to see opportunity in chaos. Step 3, pounce. This is about deploying capital when fear creates opportunities. When the economy feels shakiest, when everyone is terrified, when prices have declined significantly, that's when you deploy your cash reserves into quality businesses. Don't try to time the exact bottom. Nobody can do that. Just deploy gradually as opportunities emerge. Buy some when prices drop, buy more if they drop further. Ignore macroeconomic predictions. Don't wait for perfect clarity. If you're buying wonderful businesses at attractive prices, the macro environment doesn't matter much. Think in decades, not months. You're not buying to flip for a quick profit. You're buying ownership stakes in businesses you'd be happy to hold for 10 or 20 years. Let me tell you what Charlie Munger would say about all this, because Charlie's wisdom on uncertain times was profound. Charlie used to say that avoiding stupidity is easier than seeking brilliance. During uncertain economic times, this is especially important. You don't need to do anything brilliant. You just need to consistently avoid doing stupid things. Don't use leverage. Don't speculate. Don't panic. Don't try to time the market. Don't own things you don't understand. Just avoid these obvious mistakes and you'll do better than most people. Charlie also said that the big money is not in the buying and selling, but in the waiting. This is perfect for uncertain times. You wait patiently for opportunities. You wait patiently for your businesses to compound value. You wait patiently through volatility. Patience is your greatest asset. I remember during the 2008 crisis, Charlie and I would talk every day. The world felt like it was falling apart. People were genuinely scared. And Charlie would remind me, we're in a position of strength. We have cash. We have no debt. We own wonderful businesses. This is opportunity, not disaster. That perspective, that ability to see opportunity when everyone else sees disaster, that's what separates successful long-term investors from everyone else. And it's a perspective you can develop through study, through experience, and through conscious effort. Charlie also taught me about inversion. Instead of asking, how do I succeed during uncertain times, ask, how do I fail? Then avoid those failure modes. The failure modes are obvious. using leverage, panicking, speculating, trying to time things perfectly. Avoid those and you'll be fine. So let me bring this all together with some final thoughts. The U.S. economy feels shaky. It always feels shaky to someone. But American businesses thrive through far worse than anything we're facing today. Depressions, world wars, nuclear threats, financial crises, you name it. And businesses have adapted, innovated, and created value through all of it. Your best investment during uncertain times isn't a specific stock or sector. It's your temperament, your ability to stay calm when others panic, your ability to think long-term when others think short-term, your ability to see opportunity when others see disaster. Play defense by maintaining strong liquidity, avoiding leverage, owning quality businesses, and steering clear of speculation. Play offense by identifying opportunities, deploying capital during fear, and thinking in decades rather than months. Don't try to predict whether we'll have a recession or how long uncertainty will last. Nobody knows. What you should do is structure your investments so you're protected if things get worse, but positioned to benefit when they inevitably get better. The stock market is a device for transferring money from the impatient to the patient. Uncertain times accelerate this transfer. The people who panic and sell, they're transferring their wealth to the people who stay calm and buy. Which side of that transfer do you want to be on? I've been investing through uncertain times for over 80 years. That's how I built my wealth. Not by being brilliant, not by timing markets, not by having special information, just by staying rational when others panicked, by owning quality businesses, and by being patient. You can do the same thing. The shaky economy isn't your enemy, it's your opportunity. Be prepared for it. Structure your finances defensively, but be ready to act offensively when fear creates bargains. And never forget, your best asset isn't cash or stocks or bonds. It's your temperament, your ability to think clearly when everyone else is losing their minds. Cultivate that, and you'll do just fine regardless of how shaky the economy feels. Thank you for your time today. Now go out there and remember, never bet against America, never panic during uncertainty, and never forget that the best opportunities come wrapped in fear and chaos. Stay disciplined, stay patient, stay rational, and let time do the heavy lifting. Good luck to all of you.